Good morning. Are cap rates about to compress again? And here's the truth. Cap rates have been the central tension point in commercial real estate over the past 2 years. And rising interest rates has pushed cap rates higher, values lower, and deal volume into holding patterns. But now, as monetary policy shifts and capital slowly re enters the market, investors are asking the same question. Are cap rates about to compress again? And the short answer is yes, but selectively. The longer answer is where the real opportunity lies. So let's look at what drives cap rate compression. Cap rates compress when capital becomes cheaper and more abundant, and when investors are willing to accept lower yields in exchange for stability, growth, or strategic positioning. Now, some of these key drivers that would influence that would include declining interest rates, improved debt availability, increased investor confidence, and strong fundamentals at the asset and market level. Now, today, several of those conditions are beginning to line up again, but not evenly and not across all property types. Let's look at interest rates first, the primary catalyst. The Federal Reserve appears closer to rate cuts than hikes, and even modest reductions in the federal funds rate can materially impact commercial mortgage pricing as well as the spreads and the buyer sentiment also. But lower borrowing costs reduce required returns, which historically leads to cap rate compression, especially for stabilized assets with predictable cash flow. Now, however, this is unlikely to be a rapid or universal shift, and the market is moving from shock to stabilization and not euphoria. So, where are cap rates most likely to compress? Number one is industrial logistics. Last mile distribution, IOS, and infill industrial continue to attract institutional and private capital. And these assets benefit from long term demand drivers and limited new supply in key submarkets. Two is essential retail. Think grocery anchored retail centers. So, with service centers, retail, and medical adjacent retail, they're all trading again and offering at sharper pricing than discretionary retail assets. Three is workforce and affordable multifamily. Mission driven housing remains a preferred target for agency lenders and long term capital. And assets with stable occupancy and modest rent growth assumptions are well positioned for compression. So, where cap rates will likely stay flat or expand? Let's look at office first. Unless the asset is best in class or owner occupied, office cap rates remain under pressure due to leasing risk and long term demand uncertainty right now. And in over leveraged or transitional assets, deals with short lease terms, heavy capex needs, or floating rate debt will struggle to attract aggressive pricing until execution risk is reduced further. So let's look at the capital markets and get a reality check of where we are. And cap rate compression does not happen in isolation. The debt markets have to cooperate. So lenders today are a little more conservative on leverage, more focused on debt service coverage ratio and in-place income, but also favoring sponsors with experience and liquidity. And this means pricing will improve first for high quality assets, while secondary deals lag a little further behind. So let's look at some investor strategy for 26. If you're waiting for perfect conditions, you may miss the early part of the cycle. And smart investors are locking in stabilized assets before rates fully fall. Also structuring conservative leverage, but targeting markets with population and job growth. And planning refinances instead of quick exits. And cap rate compression often begins quietly before the headlines catch up. So don't get left behind. And here's the bottom line that cap rates are not compressing everywhere, but they are already compressing somewhere. Now, if you understand which assets lenders favor, where capital is flowing, and how to structure debt intelligently, the next 12 to 24 months could offer outsized opportunities. And if you want help underwriting, financing, or sourcing assets positioned for compression. Now's the time to start the conversation. And that's what I'm here for. Please visit my website, HoustonRealEstateBrokerage.com, to get a hold of me, and we can chat more soon.